Welcome, market participants, to another Three Things in Credit. I'm Van Hesser, Chief Strategist at KBRA. Each week, we bring you three things impacting credit markets that we think you should know about. One of the more insightful comments I picked up on this week came from David Kelly, Chief Global Strategist at JP Morgan Asset Management, who observed that markets have desensitized to Trump. I suppose that's true if I consider that the S&P 500 is at or near all-time highs, credit spreads are at or near all-time tights, and even the 10-year has settled into a reasonable trading range, at least this week. This despite more saber-rattling around tariffs, where it remains difficult to find those who believe that will be a positive for risk asset prices. Markets, at least for now, believe there is more bark than bite coming out of this White House. This week, our three things are: 1. Euphoria downside, the not-so-silver lining to optimism. 2. M&A downdraft, what it means for credit. And 3. 10-year direction, where it's headed. All right, let's dig a bit deeper. Euphoria downside. Animal spirits unleashed, deregulation, a businessman in the White House. All of that fed into a post-election tailwind to risk assets and growth expectations. But now we've been hit by two debatably hot inflation prints, CPI and PPI. Hope for rate cuts has diminished. Market inflation expectations have jumped, and tariffs are on deck. None of that feels good for fixed income. We could just echo what we heard several times this week. You guessed it. One data point does not make a trend. And while we think that there are plenty of extenuating circumstances explaining the heat in the latest prints, and we continue to believe inflation continues to move toward target, there are some behavioral elements in this story that are worth considering. 1. Prices get raised in January. It's a mechanical thing whenever we are not in or pointing to recession. 2. Businesses raise prices into euphoria because they can. What constitutes euphoria? Well, the NFIB Small Business Optimism Index spiking from below average doldrums to a level hit only 3 times in the past 40 years. In 1 month. That is euphoria. Do you think sellers thought now might be a good time to raise prices? 3. Tariffs are coming. You, the seller, have had plenty of warning. Why not get out in front of that and try to pass along whatever you can? At least some of that made its way into the inflation data. So, are markets concerned? Well, a recent poll of 4,200 market participants in 60 countries conducted by the digital markets folks at JP Morgan identified inflation and tariffs as their number one development expected to have the greatest impact on markets in 2025. That's about 3 times more than the next most cited development, geopolitical tension. So yes, market sensitivity is high. But euphoria is fading fast, according to a headline this week in the Wall Street Journal. The piece cites falling consumer confidence and concerns over a trade war. We see it in the data with Q4 GDP moving, i.e. slowing, toward normal, CapEx negative, housing struggling. All good reasons to acknowledge that one data point does not make a trend and fade the inflation trade. But let's not lose sight of where we are. In that JP Morgan poll, only 7% of respondents highlighted recession risk as the thing worth watching, down meaningfully from 2023's poll, where it came in at 30%. Now, that might not constitute euphoria, but we'll take it. All right, on to our second thing, M&A falloff. Now, speaking of one data point does not make a trend, this week we saw January M&A volumes coming in at the lowest level in a decade, 25% below the year-ago level and 40% below January of 2023. Well, that's not supposed to happen. Not with the unleashing of animal spirits. Not with Andrew Ferguson replacing Lena Khan at the Federal Trade Commission. This is supposed to be a golden age of M&A. Do we care? Well, the direct impact on credit markets is on the technical side, as M&A-related new issue can be a material factor affecting supply. So less M&A means fewer bonds sloshing around, and that should be positive for spreads. But it's also worth considering why M&A volumes are off. Increased uncertainty. Uncertainty related to difficult-to-dimension policy effects related to, you guessed it, tariffs, immigration, tax cuts, and geopolitical tension. Things that are difficult to model. One of the things I've learned over the years is that it's tough to model politics. And let's not lose sight of valuations. They're historically high. The rising tide of the past couple of years has lifted a lot of boats. Change of control prices in many sectors are prohibitive. But let's curb our angst on this one. Getting buyers and sellers back on track will take time, but signs point to that happening. In the meantime, reduced M&A related supply only enhances the strong technicals underpinning credit. All right, on to our third thing, the 10-year direction. So we know Treasury Secretary Bessent is trying to get the president to focus on the 10-year Treasury, the benchmark so important to real estate markets and corporate capital formation. In the era of Trump 47, which probably ranges back to October, when he began to take the lead in polls, the 10-year yield has literally moved within a 1-point range, 378 to 479. And at each extreme, there was an avalanche of commentary about how the momentum in that direction would continue. So given that we are at a point in credit markets where the movement in the Treasury market is dominating your return, it's important to have a view. And so we pose this question to clients we talk to. Which threshold, 4% or 5%, do you think the 10-year will cross next? Let's lay out scenarios for both. The 4% outcome needs slowdown to continue. We would need to see weakness in the jobs market beyond the bad news is good news phase, where risk markets rally on downbeat news on hopes of a dovish response from the Fed. Sustained weakness in payrolls, say around 100,000 jobs a month, accompanied by weakness in retail sales and weakness in capex. In other words, a lot of heat coming out of the economy. The 5% outcome could result from two catalysts. One, stronger than expected economic growth, continued strength from the consumer, and a robust commercial sector. Wage pressure reaccelerating, hot inflation data. That's one way home. The second could be increased concern over U.S. deficits and the crowding out effect. Call it bond vigilantism or a buyer's strike, call it whatever you will. Rates marching higher as Treasury supply pressures demand. Well, we're in the 4% camp, but full disclosure, our view is that the 10-year will trade in a range in 2025 between 4.25 and 5%, with plenty of headline-driven chop. We think either scenario would have to incorporate something meaningful that is materially different from the status quo of solid but unspectacular growth, healthy labor markets, well-behaved inflation data, and favorable financial conditions. By the way, that's a pretty attractive backdrop for credit. Now, we don't see the likelihood of either threshold being hit and sustained over the near term as very high. We are in the camp of economic growth normalizing, moving down toward 2% eventually, but that feels like a 2026 event to us. We do think rate cuts are still in the picture. 2 25 basis point moves is our forecast, but that feels like a Q4 2024 or later event, concurrent with growth normalization. Tariffs are an interesting piece of the puzzle. We see them as a tax, and that's anti-growth. The inflation risk related to tariffs, assuming a one-time adjustment to prices, is over the near term, which could have the effect of preventing monetary easing. Eventually, rate cuts could happen, but only after it is clear that the economy has slowed, and that will be a function of just how long and how pervasive tariffs will be. So expect plenty of volatility in the rates market as investors react to a very fluid policy backdrop in 2025. So there you have it. 3 things in credit. 1, Euphoria downside. The risk is inflation reigniting, but we're confident we remain on track to target. 2, M&A downdraft. Reduced supply only enhances the strong technical underpinning credit. And 3, 10-year direction. We see it as being range-bound in 2025. As always, thanks for joining. Don't forget to check in on kbra.com for our ratings reports and our latest research. We'll see you next week. And if you're going, enjoy the Eagles parade.